Hey guys, Caleb Gregory here. I want to go in detail today why the stock market has been going down and why it's poised to go even higher in the quarters to come. And you're going to want to know this information. This is a lot of macroeconomics, but it gives you an insight as to why things are playing out the way they are, and how to prepare for what's ahead. Because I think you're like, what's ahead? And I'm going to go through that slide by slide. I'm going to take my time through this and try to give you as much information as I can without belaboring the point or being boring or any of that. So here is why the stock market is poised to erupt in 2026 and why it's come down in 2025 to begin with. So let's go screen share and get out of here, go to slideshow. All right. So this is the macro outlook, November 2025. Just a little bit about what's been going on. So here we have the first slide from the Kobayashi letter on X. The U.S. Labor Department announces canceling the October jobs report for the first time since 2013. We will not have a monthly jobs report. All right. So why is that going on? So yeah, this is a huge thing, the macro. So the government shutdown continues to leak out in more places than one for why, how it's affecting the stock market, how it's affecting the labor markets, how it affects liquidity in the system. So that's kind of what we're seeing right now is with the US canceling the jobs report for October. It is a little bit of a tug of war between the United States government and the Fed, the Federal Reserve. So obviously, you've been hiding in a rock if you don't know that the U.S., the government, is very much pushing for for rate cuts, for cheap debt, cheap funding. They want the cost of money to go down, which is through rate cuts. So the Fed, which is an independent organization, at least they attempt to be. So that's a conversation for another time. They have been very combative with the current administration on lowering rates. People tend to not think they tend to not think that the rates are being cut quick enough. And so that's kind of what's going on in the market right now, from the labor statistics side. So this whole thing is just kind of covering up the fact that the October jobs market is not going to be a good report. It's just not. The government shutdown affected it way more than people thought, and it is simply something that is not going to be a good report. And let me just state for the record, everything that I say here is apolitical. I don't pick sides. To me, it's all about the Green Party. And no, not that Green Party. I'm talking the money party, the investors party. What's going on in the market and how's it going to affect us? So anything I say here is not an indictment or an endorsement on anything here, but simply my observations of what's going on. So once again, we're live on TikTok. The screen share can be seen on YouTube. So yeah, the next slide. So today, the Fed released their minutes. And so what you are seeing is a divided Fed. So only several participants supported rate cuts in the month of December. A lot of participants are concerned that cuts could add to the rising inflation. Many think that it's appropriate to keep rates solid for December. And so what we have seen is the chances for a rate cut have shrunk in December. This is more tug of war between the Fed and the current government administration. So once again, this uncertainty and this back and forth is a huge concern to the market, and the market is reacting because here's what happened. The government shutdown has caused a liquidity crunch. So across the board, liquidity was drained out of the markets, and you are feeling it in assets and stocks. And here's the deal. Um, so pretty much, the Treasury General account could not be accessed when the government was shut down, and the government is the single biggest spender that stimulates the economy, whether we want to admit it or not. So because of that, all the liquidity has been drained out of these markets, and they are desperate to get liquidity back in the markets, especially the government. And the Fed is always slow to react to these things. So the Fed is always very reactive instead of proactive. So the Fed always starts cutting too late. They do not cut aggressively soon enough. And a lot of things go into the Fed just simply being late to the situation and not helping the economy in the way that it should. So what we see now is the chances for a rate cut in December have shrunk a lot based on prediction markets that tend to be pretty accurate. Give it about a 35% chance right now, at the time that I see this. So That's kind of what's going on there, and that constant tug of war between the Fed and the current administration has markets scared along with the lack of liquidity. So another thing that has the markets fearful and is the Japanese yen carry trade is starting to unravel. So we saw cracks in this earlier this year, back in the spring, and it is rearing its ugly head again. And if you don't know what the yen carry trade is, the Japanese yen, you could borrow in artificially low environments for a long time now. I'm talking since the 90s. And so what they would do is you go borrow yen at little to no interest, and then you can simply go into US Treasuries and get bigger interest payments, and then basically what you're doing is an arbitrage trade. So that arbitrage trade became a billions and billions of dollar type of trade, and maybe even trillions of dollar type of trade. I don't have that data right in front of me. And it's starting to unravel because the yen just hit its lowest point in the dollar in a long time. Markets are nervous about that because if that trade unravels, it is propped up by a ton of leverage and debt, and that can trickle throughout all markets. So that has people fearful. So the Japanese yen trade needs to this needs to get fixed. And so we got some slides and some things I'm going to talk about later, what they're going to do to combat this. But this is another thing in the market that is simply causing fear in markets. And once fear gets momentum, you know how it goes, then the algos kick in and things start trading down and down and down. So that brings me to today. So JP Morgan today issued, they're getting ready for the everything rally. Yeah, everything rally. JP Morgan says that given there not been any changes to the fundamental story, nor does our investment hypothesis rely on Fed easing, we are dip buyers. As we look at two key events this week, September's NFP and Nvidia earnings, when combined, this could set the stage for the next run through all-time highs. So as I read this, Nvidia earnings have happened now. Those have been read, and Nvidia beat across the board, which is really good for markets. Nvidia is up 4% after hours, and even raised their guidance as well. So very bullish. And so JP Morgan and their trade desk are saying that this is a buy the dip moment. So I often like to say, listen to what they say and but really pay attention to what they do. So the fact that we're kind of talking about buying the dip here and we're not being more bearish tends to align with what I'm seeing and what's going on in the market right now is that they simply cannot afford to let the market crash. And so based on this JP Morgan data that was released today, the everything rally, I want to read a little bit of reasons now that you need to be very bullish for 2026. So this is why the market is going to go up, and it's going to go up relentlessly in 2026, and I firmly believe that. And I got a few data points that I want to touch to kind of defend that and go over that. So let's just go right into it. So, first thing is the Fed is ending QT on December 1st, which is quantitative tightening. So, quantitative tightening is essentially the shrinking of the Federal Reserve balance sheet, which is essentially the draining of the liquidity that circulates within the system. So, because of that, what that does is it just removes the amount of available dollars circulating in the market that can be used to drive asset prices, to drive everything. So, obviously, you try to use quantitative tightening. The Fed uses quantitative tightening to try to get a hold of inflation. Because if you can contract those markets and everything that's going on there, you can start to bring down inflation. You can get it controlled a little more, or at the very least, you can chill it out and try to cool it off some, which is what our Fed has been doing. So we've been in quantitative tightening for a few years now because of all the liquidity injected in the markets during the COVID crash. And so the Fed has been contracting all of this time, and we've been in a bull market, which is a very, very strong sign. And so the Fed it has announced December 1st, we're 2 weeks away, that they are no longer going to be contracting their balance sheets, that they are actively ending quantitative tightening. Now, why is this important? Um, Obviously, I've alluded to it already. there's been a tug of war between the current administration and the Federal Reserve on how to handle the situation in the economy, the markets, how what they just kind of believe differently on how they should be responding. So this is a step towards what the administration wants to see. The administration has stated before they want to run it hot. They want to run high on growth, which is likely going to run high on inflation as well. But it is a way to scale and grow and really just ignite growth into everything. So quantitative tightening is ending, and that's a huge deal. So by default, with quantitative tightening ending, you're going to start seeing stealth QE, which is quantitative easing. And so that is exactly what it sounds. It is the opposite of the contraction of the Fed balance sheet. It is the expansion of the Federal Reserve's balance sheet. So the Federal Reserve soon will begin QE, but most importantly, in the very near future, we're talking weeks, quantitative tightening is over, and the intentional collapse of liquidity sloshing around in the system is coming to an end. So the end of QT is a big deal and tends to lead to bullish movements in markets. So take a look at the next slide. Stimulus is on the way. So, if the Fed isn't going to play ball, what's one way that the United States government and foreign governments even can get liquidity back into the system? It is a stimulus directly to its constituents, right? And so there are a ton of stimulus on the table. The US is preparing a $2,000 stimulus check to go out in mid 2026, which is just in time for the midterm cycle, which is incredibly convenient, right? Just a coincidence. Japan is preparing a $110 billion stimulus package for its citizens. China has approved a $1.4 trillion stimulus package for its citizens. The Fed wraps up QT on December 1st, and the United States of America is issuing 1.9 trillion in treasuries. So they have to print the money. They have to print the money. That is the only way you keep a debt-based society alive in this instance. You have to print the money. So they are gearing up for the next round of printing, and stimulus is just one layer of injecting liquidity into the economy because the liquidity is going to get injected. It's the same thing they did during COVID, but I think that this liquidity injection is going to be at an even more massive uh, juncture than COVID. It's really they're gonna be injecting so much liquidity into the system because they want to run it hot. They want to look good in 2026. They have to look good for midterms, and they're going to do everything they can to prop up these markets going into midterms and into this season. And that's whatever party's in charge. It doesn't fall to a particular party. They're going to do what they can to maintain power, to maintain control, to maintain their grip on everything. And in a debt-based society where you are the world's reserve currency, it is your job to export the currency. That's what we do. We export the currency and we import goods. So that is what is going on. We are preparing to create more of our currency so that we can keep the debt wheel rolling. Now, that is going to flow into assets, that is also going to flow into goods. It is going to cause more inflation, but assets inflate too. So obviously, this is where you create the old saying, the rich get richer, the poor get poorer, is because you either own assets and benefit from the money printing, or you don't own assets and you get burned by the money printing. There's only two sides. And I understand that everybody doesn't necessarily get their choice and that it's hard, but that's the reality. This is what is going on. So, going to next, the Deutsche Bank expects the Fed to start QE in 2026. So this is kind of the first bit of speculation that I'm sharing here is the fact that they expect QE to officially ramp up in Q1 2026. Um, they got it right last time the Fed began QE, and honestly, I expect them to be right there. Obviously, there's a lot of pressure on Jay Powell already to fire up the money printer and to start the expansion of the Fed's balance sheet. And so that is coming down the pipe is they're going to start QE. And here's the deal. Worst case scenario, Jay Powell is out by the summer and QE gets fired up then because Trump is going to put whoever he wants in there and they're going to do whatever he wants. And he wants the money printer turned on because it has to be turned on to keep the system going. So QE is around the corner, stimulus is around the corner, QT is ending, and the markets are going to rip. So, basically, what does all that mean? Let me go full screen and stop sharing for a minute. So basically, what that means is they are gearing up to do exactly as they said in 2026. Scott Bessent said, it's the Treasury Secretary, he said they are going to run it hot, and they are. They are preparing to run the economy incredibly hot. That's going to be hot on growth. It's going to be hot on inflation. It's going to be high on money printing. It's going to do all of these things. And so, how can you prepare is to own assets. All right. Owning assets in times of high money printing is how you beat inflation. It's the only way. So the markets have been beat up right now because the liquidity has been drained from the market. And there's a tons of back and forth, tug of war on how to approach, how to handle this situation. But the end game is inevitable. They're going to print the money. Stimulus is going to inject into everyday Americans' lives. QE is going to begin, and they're going to get incredible amounts of liquidity sloshing around the system. Liquidity moves markets, and that's what's going to happen. So, you want to own assets, and the market is going to rip because of this. It has no choice. When you inject more money into the system, inflation happens, and inflation hits assets. That's why assets go up. That's why you see gold has saw this coming, and gold has ripped. Gold is defensive. Gold knows what's coming ahead, and it's already front ran this movement because those who know and understand the macroeconomics and the backdrop and the outlook of what's going on know that the end goal is inevitable, that they are absolutely going to print the money. So, how do you combat that? You own assets. You stay exposed in the stock market, and if you can, you are buying the dip. You make sure that you do not get stopped out right now because they are testing your resolve in the current situation. They want things to sell off now because they are getting retail to capitulate so that they can get cheaper prices, scoop these assets up right before the big print happens and things start to rip back up to all-time highs. It's exactly what they're doing. So this is a mind game, it's an emotional game. How strong can you be? How much pain can you take before you capitulate? That's the period you're going through right now is how much pain can you withstand before you click that sell button, tuck your tail and walk away with losses? Or can you withstand the pain? Can you ride out the volatility? Can you wait until the money printer is turned on, till they ignite the growth within everything that's coming? It is coming. It has to come. That there's no way the economy, there's no way the system can survive without them printing more money. It's just the way the world works. It's a way it works when you are the world's reserve currency. You have to print, you have to run in a constant deficit. So it's coming. I am preparing by buying assets and loading up responsibly with as much of my favorite assets as I can. That's the favorite stocks that I like that really should thrive in a risk-on environment where markets are running hot. It's some AI names. I'm a big believer in Bitcoin. So of course I'm buying more Bitcoin, especially as it's sold off by nearly 30% as I'm recording this video, which is great if you're a buyer. Obviously, it's painful in the moment if you hold. So I'm buying Bitcoin. I have bought some leaps, which are long dated options on a handful of my favorite positions. Those leaps are positions that I believe in and that I think are going to play out really well in the long term. And so I'm preparing by buying positions that I think financially will benefit me the most during this time. So be prepared. It's coming. They're going to print the money. They have no choice but to print the money, and they're going to do it at a convenient time that is going to leave people feeling high going into midterms, and that is their goal. So right now, it's games. It's they're playing games with liquidity, they're playing games with leverage, they're playing games with all this other stuff going on. And so what you actually see is sell-offs can be healthy in markets, and they are healthy to take the next leg up. We have deleveraged the market so much in the last few weeks because the market had unreal amounts of leverage and a lot of that got wiped out, and things need wiped out like that to take the next step. So the market is preparing for that next step. So all of this to say relief is on the way because it has to be. That's the only way they keep this thing propped up. It's the only way they keep this thing running. So if you own good businesses that you believe in and you own stocks that you believe in or hold assets like Bitcoin that you believe in, you simply have to ride these waves out. Do not capitulate. Do not um, get stopped out right at the last minute before they let this stuff rip because it is coming. And there's only one way they can get out of this. There's only one way they kick the can down the road, and that is by printing money, injecting liquidity, and moving markets. So I've been talking for 20, 25 minutes now, and there's no, I'm saying the same thing a lot, but I say it all to say this is the result. This is what is going to happen. This is what is going to play out. So, need to do our best to be ready for it, be prepared for it. And this is a video we'll look back on in a while and say, yeah, okay, this was the playbook. This is what happened. So it's going to happen and it's starting to play out now. So own assets, don't get stopped out in these short-term games. If you don't need the money that you have invested right now or next week, you're going to be fine as long as you're allocated to businesses that you believe in. So hang in there, keep investing, keep buying your favorite assets, and things will continue to improve and get geared up because the money printer is about to come on and it is about to be humming.